Hi, welcome back to the live stream. My name is Victor, and I appreciate you joining the live stream for a review of the stock market, review of the week, and review of this rally that we're on. I'm a value investor, and my intent is to find companies that are undervalued. Every market, no matter whether we're in a bull market or a bear market, every market will give an investor the opportunity to find companies that are undervalued. And my intent is to find those companies that are undervalued. It's usually sectors that are left behind, companies that are forgotten, in some cases, small companies that are going to take off someday. So I appreciate you joining. And looks like we have somebody joining. And appreciate you joining. If you have any questions along the way, please put them in the chat, and I'll try to respond as quickly as I can. So let's get started and review the market. So to begin with, the the market is on the 7th week of this rally, and as I've mentioned before on my channel, it's beginning to feel like it's too many weeks in a row that we've been up and up and up. And I feel like there's got to be a negative week mixed in, because this has been an excellent rally, started October 27th, but it's got to give some kind of relief at some point. Not wishing for it. I'm just expecting it, because stocks just don't go up, up and to the right. They tend to go up and then have a pullback, up, pullback, and so forth. My guess at the beginning of this week was that we were going to have a pullback. There was a good chance we were going to have a pullback this week, but it didn't happen. The indexes went up, and they went up well. I'll go over some of the reasons for it. We had a lot of economic news. I'll review that and kind of go over how the economic news affected this week, but more importantly, is setting up the rest of December and setting up the beginning of 2024. So I'll go over that. But yeah, Santa Claus, that comment came in. Is this a Santa Claus rally? We actually haven't entered the time frame for a Santa Claus rally yet. Santa Claus rally is going to begin, I believe, in about a week. And we oftentimes see a rally right around the beginning of the Christmas holiday. So we haven't even gotten into the Santa Claus rally time fence. We'll see if it happens this year. Santa Claus already gave us, or whoever, the universe gave us a bunch of gifts already for 7 weeks. All right, so let's take a look at the different indexes, starting with the Dow Jones. I wanted to start with the Dow because it hit an all-time high. And it hit an all-time high. And if you look at from, I believe it was October 27th up until this point, it's up 15%. That's basically in a month and a half, it's up 15%. And the Dow is made up of more traditional stocks, kind of like older companies. These are dividend paying companies. So it's good to see that index rise. For the rest of the year, you see that it wasn't doing all that hot. You see that it went up 15% in the last month and a half, but for the year, it's only up 13%. So if it didn't have that big rally, it would have been flat for the year. And that coincides, or it aligns with the stocks that I have that are more Dow-based stocks. They haven't really moved. They've been kind of just going sideways, meaning they don't go up or down very much. The good news is that there's dividends usually involved with Dow stocks. So on top of, let's say, a 13% return for the year, there's usually a dividend involved. So it might even be 13 plus 2% or 3%, depending on the average of your dividend. The S&P, which is the most watched index of all, it's really had a pretty nice shape to it. It's gone, nicely to the right and up. And if you go from October 27th up to the point where it's at today, it's up 14.6%. So pretty good rally. The S&P these days, or this year, is really lopsided because the 7 biggest stocks in this index represent over 30% of the value of the S&P. So 30% go to 7 companies, and then 493 other companies make up the 70. So I think that's kind of it's throwing this index off, in my opinion, because depending on how those 7 stocks move, it moves the S&P. But it's up 22.5%, which is an excellent year. Looks like we're going to have a good year in 2023. And it's a rebound year from 2022. 2022 was kind of a painful year, if you recall. If we look at the beginning of 22 to the end of 22, we were down 18%. So last year was kind of a painful year, but it was also an opportunity year because last year you could have bought a lot of quality companies that were really discounted, and you just had to stomach through a lot of down days and a lot of pessimism, a lot of bad news. So that's where the S&P is. The NASDAQ has more of the technology stocks, more of the high growth stocks, biotech, things like that. It's doing very well, 38% for the year. That's phenomenal. And it's up 17% since October 27th. So any way you look at the NASDAQ, it's doing great. But last year, it did quite terrible. Let me show you what it did last year. So last year, from start to finish, it went down 33%. So the NASDAQ has, it's more volatile, it's higher growth. It goes up much faster, but also falls much faster as well. The next index is the Russell. The Russell represents small and mid-cap stocks. And I've been following the Russell because it was my observation that small and mid-cap stocks were kind of being left behind for the first 9 months of the year, 10 months of the year. And what it's done over the last, month and a half, it's up 21%. So it's really, really picked up. A lot of small stocks are rallying. Really good things are happening with small stocks and mid-cap stocks. And I think this rally is going to extend into next year. If you see, it's up 21%, but for the year, it's only up 12%. For close to most of the year, it was not keeping up with the S&P. So the S&P had a more kind of straight line to the right, upward, and the Russell 2000, you could see big separation, especially as we reached the end of October. Small caps were just being sold off. A lot of hedge funds were shorting small caps. So now they're really recovering, and they're recovering fast. So it's a really nice recovery trade. And I think it's going to extend into 2024. I had been buying into small caps, and I continue to buy into small caps. The last item I'll cover is the VIX. So the VIX is the volatility index, and it basically measures, sentiment. Are investors scared, or are they comfortable and in rally mode? They're buying. And you can see that, this year we've had some really high peaks. And more recently, you can see that there was a lot of fear in the months of October, September. The fear index really went up. Things were really oversold, especially with small caps, and it's really dropped off. Over the last month, you can see that it's really stayed down, which is interesting. We've had big announcements from the Federal Reserve. I would say economic data did keep things stable because there wasn't any big dramatic news like, oh no, unemployment's really growing fast. We think we're going to have a really bad recession. No, it's actually the economists are thinking we're going to have a light recession. So overall, I think the VIX is showing that investors are comfortable investing, and that's where we're at with volatility. Okay, so that's what we've seen with the VIX. Now, I wanted to go over all the news that happened this week because it was a lot of news, but the news was either good, positive, or neutral? Let's go over it. So on Tuesday, we had the inflation data, and the inflation rate came in at the consensus, showing that inflation is on its way down. And the actual year over year is at 3.1, and I believe the core is at 4. And that's where they expected it. And the Federal Reserve has a lot more data, so they're seeing that inflation is really going down. One thing that's helped inflation is oil prices are down, which really helps. So we'll see where that goes. And then on Wednesday, we had the biggest news was the federal decision, the Fed's decision on interest rates. They held them the same. And then in their comments, they were saying that they're probably going to have a couple rate cuts in 2024. So that really made people feel like, hey, we got to start bringing down the discount rates we use on stocks, and the stocks rallied. If you see the interest rate on a 1-year T-bill went down from 5.1 to 4.6, on a 2-year 3.6 versus what was expected at 3.9. As we go longer term, they pretty much stayed the same, but it really affected short-term rates, which was interesting. Thursday and Friday, the jobless report, I think people are employed. People that want to work, for the most part, can go to work and have a job. So the jobless claims they actually came in a little lower than what was previously reported. So people are employed. The recession isn't going to be all that bad. And again, that added to the comfort level that, hey, stocks are going to do well in 2024. Then today, not a lot of news, just a couple indexes of manufacturing and so forth. But these don't tend to move the market. They're just informational. The one thing that's really moved are interest rates. And interest rates, like today, they were pretty flat. But for the week, and I'm going to use the 10-year because the 10-year is the most watched interest rate factor of them all. And if you look at the 10-year, you can see this big drop. It's dropped from 5% down to below 4% very quickly in a month and a half. And coincidentally, that's how the stock market's really rallied. So the interest rates really do affect stocks. As interest rates fall, obviously stocks become more attractive. And it really retraced a big rise in interest rates that happened probably from the late July standpoint up to the middle of October. And that big drop has really helped stock prices. So bonds, are really benefiting from higher interest rates. But as we see this interest rate drop, I'll show you how it's affecting bond prices. If you're owning bonds and you bought them at the right time, let's say around this peak, you're looking at gains on your bonds. Now, I don't buy bonds to make a gain on the value of the bond. I just want the interest rate. I want a good interest rate. I want it defined, and that's it. Stocks is where I'm aiming to get appreciation on the stock price. But buying, bonds in that peak, the ones that I bought really have big gains on them as well. All right, so we've gone over the indexes. A couple highlights. Let's look at sectors and where they've performed. So technology came back. Technology didn't do well yesterday, but it bounced back, principally because some of the big caps, for example, Microsoft did well today. So that has a big effect on the market. So technology is back. And hey, technology was the number one sector for 2023. So it measured at the top. Consumer discretionary keeps really doing well. You can see that it's done well for the month. It's done well year to date. There's a lot of interesting consumer discretionary stocks, and that's a big category. So for example, Airbnb is a consumer discretionary company. I think of it more of as a technology company, but it's a consumer discretionary company. And it did well. Communication services, most notably Google's in here as well as Meta. So it measured up in the positive, and then the S&P was just slightly down. And all these other sectors underperformed for the day, but some of them are just doing great. I think I've talked about financials doing great. Real estate's really stood out for the last month. And I think this is where there's going to be a big rebound for 2024 is in these sectors where these are a lot of companies that have been forgotten, unappreciated, but they make a lot of money. They're beginning to grow. They generate great cash. And I think for a value investor, they're really attractive. So a couple of notable things on my portfolio that happened today. I'll start with a couple of stocks where I started a position. And first with AT&T. AT&T for a while, I didn't own any shares because I thought their balance sheet was terrible. And they've really worked on making their balance sheet better. And now they're within that 3 times EBITDA that I have as a qualifier to buy. I think they have a good proposition for the year. They're down 10%, but they pay a really nice dividend of 6.72. So I started a position and bought shares in AT&T today, and I caught it on, I think, a nice down day. So it's good to buy AT&T, and I'll be buying on dips going forward and building a position. I'm comfortable with AT&T. I mean, it's a very well-known company. The second stock that I started a position, I didn't own any shares before, but now I do, is Guess. And Guess is mostly an apparel company, but they have a variety of products. This company, let me get myself out of the way here. So Guess is doing well. They're up 16.5%, and they pay a nice dividend of 5.15%. So it's a nice diversification play. It's also a small cap. It's only the market cap's 1.25 billion. So that's a nice small cap. And I think small mid cap stocks are going to really do well at the beginning of 2024. So I started a position in Guess. Now, I'm probably not going to build up this position as big as, let's say, an AT&T position, and principally because it's a smaller company. And I tend to have more names of smaller companies to kind of diversify the risk and put smaller amounts into each company. And again, the aim is to diversify on risk. My top and bottom movers today, Zim was top mover. This is a company. I have a video on my channel if you want to get more analysis on it, but it was up almost 18%. And the news is that Zim is a shipping company. So if you want to move goods from one place to another in the world, Zim has these big container ships that will move cargo. And it's been reported that, the conflict in Israel, there's a scarcity of shipping vessels going through the Suez Canal and in the Red Sea. And there's some complications with the Panama Canal where there's not enough water in the canal. The rain season has been less than anticipated. So those factors are going to drive up shipping rates. As shipping rates go up, Zim becomes more profitable, potentially very profitable. So it's really ran up. And what's interesting is that Zim has, I think 25% of the shares are shorted. So if it keeps moving up like this, I think it's up like 25, 30% in the last 5 days. It's probably going to squeeze those short sellers and cause an even higher stock price. We'll see what happens with Zim. The second company is DocuSign. And DocuSign had a press release that they are looking, I guess there was an offer on the company. Whenever there's an offer by some private equity firms, there usually is a good premium they're going to pay on the stock. So I have a video on DocuSign, and in the video, I talk about how I think it's a good acquisition target because it keeps growing, it's profitable, it generates free cash, but the stock price is just really beaten down. easily another company, in this case here, a hedge fund, or excuse me, a private equity group, will buy the company, probably make a few changes, and then go public again with the intent of making a sizable gain on the stock. We'll see how that plays out. But for today, it was up 12.46%, which is a really nice gain. Enphase is the next one. And Enphase is just really benefiting from lower interest rates. And it's one of the best performers, I believe, in the NASDAQ over the last 30 days. I believe it was the top performer. So it's good to see this company. I think they make really good products for solar. They were just getting beat up because the higher interest rates caused the market to think that not a lot of people are going to get solar. But today they had a good day and they've had a terrific month. The stocks that were down, MPW was probably the worst performing stock, but it was one of my best performing stocks yesterday. MPW is a high risk company, pays a high dividend, but it was down, and I can't put my finger on exactly why. Coinbase was down. Coinbase is my number one percentage gainer for 2023. And, it beats out everybody else. It's up more than 300% for 2023. And it was down because they're trying to get ETFs approved for cryptocurrencies. And there was some pushback from the Department of Justice or whoever governs that area. So that pushback is what caused the negative press and caused the stock price to go down a bit. And that also affected Robinhood, because Robinhood would like to have an ETF and they'd like to sell that ETF on their site. Robinhood is also big into cryptocurrencies. Coinbase is exclusively cryptocurrencies. Robinhood does stocks, and they also do cryptocurrency. So it affected those two stocks. So we talked about interest rates, and I just wanted to talk about bonds. Now, bonds are pretty boring, but they serve a purpose. I'm 55, and as I look to retire early, I want to get good at creating income and income with low risk. So I've been buying bonds and created a bond ladder. I created a video on that, and you can check it out if you'd like. But the bond portfolio has been producing 7.41% performance, which is really good. And part of it is because, I locked in really good returns when interest rates were really high. And if interest rates continue to fall, I'm still guaranteed that rate of return for the next couple of years. So I'm glad I put some time and energy into bonds, kind of knowing where to buy, diversifying my buys, and my bonds are doing really well. As interest rates have gone down, the bond values go up, but the intent in my bond investing is not to see my assets appreciate. It's really just to get that income, because at the end they just return the par value of the bond to you, and they pay you interest in between the time you buy and the time it matures. So it's been a good thing to get into bonds this year, and really have collected a good return. I have 3 portfolios. This is the least risk portfolio. My bond portfolio is low risk. My income portfolio is more risk, creates income, dividend, related stocks. Then my growth portfolio is the biggest, and it had the best return this year, but it also has the highest risk. So what's going to happen, going forward? Now, to begin with, I really like what Peter Lynch has to say, which is nobody can predict interest rates or the future direction of the economy or the stock market. Nobody can. But I would say that certain factors that we see are probably going to influence that. Hey, lower interest rates and the expectation of lower interest rates is going to be a tailwind. It's going to be good for stocks to continue to go up. The other factor is small mid-cap stocks have been left behind, and I think they're catching up, but they haven't caught up yet. I think small and mid-cap stocks have just started, and I think investors that were in early are, very happy because they're seeing stocks are really going up. But I think the general investors now keying in and realizing small and mid-cap stocks are a really good investment. So I think a lot of capital is going to be poured into these smaller cap stocks. and they're going to continue to rise. I expect them to rise at least through the beginning of 2024, if not through the first half of 2024. And I'll continue to adjust my plan, each month, so that I'm putting money where I think it's going to be perform the best. And the last thing being, some sectors have been pretty much forgotten. I think healthcare is going to bounce back, in 2024, because it has to. They make too much money. Pharmaceutical companies make a lot of money. Healthcare companies make a lot of money. And at the end of the day, as Warren Buffett would say, that in the short term, the stock market is a voting machine. And in the long term, it's a weighing machine. Short term, companies get votes. The popular ones get run up. But over the long haul, the weighing machine is weighing profits, free cash flows, true value of a company. And that's what tends to bring long-term appreciation in a stock. So I'll continue to buy healthcare because I think it's going to come back. And a couple other industries like materials, industrials, I think they're going to bounce back in 2024 as well. Every market will present opportunities, but as a value investor, it's the challenge is to go find where the sectors are that have been left behind, which companies are undervalued, disliked, and I could pick up at a really good price, and then go buy those companies. So that's the challenge, and it's a constant effort, but it's a lot of fun. It's a lot of fun to go find companies and buy them when they're really low priced. All right, so that's the end of my live stream. If there's no questions, I'll conclude the live stream. I really appreciate you joining and attending, and I hope you have a really nice weekend.